Let's get more with Khiem Do. He helps oversee $11 billion and is head of multi-asset strategy at Baring Asset Management. He joins us from Hong Kong. Thanks so much for joining us. So let's come to China in a minute. But first of all, equity markets have been falling back in recent days. Is this just a temporary thing, or is this the start of a more downward trend?
We believe that this is a short-term correction as a result of the normalization of monetary policy in China. And the timing of that was a little bit earlier than what the market had expected. So that's why there has been some profit taking in the Chinese market. But we think that the Chinese economy is very robust, and the Chinese financials in terms of balance sheets and growth profile are still very strong. So we think that after this correction, perhaps the market will bottom out within the next maybe 5% or so from current levels, and that should be a buying opportunity.
So you're expecting, from your notes that I've read, a global stock market rally for the next 12 to 18 months. Why is that? Investors are clearly concerned.
Yes, no, indeed, there's always a risk, or there's always concerns around. However, let's look at the facts again. I mean, the U.S. economy and European economies are recovering at the moment, so they are just on the cusp of a global economic recovery. China, India, and the rest of Asia and Latin America and Russia continue to grow quite strongly. Equity valuations are not expensive at these levels, and we think that the overall global liquidity remains quite ample. There's still a lot of that, there's still a lot of low-yielding money market funds which are very eager to get back into the market at some stage. So overall, we're still quite positive on the outlook of equities over the next 12 to 18 months.
But you're positive because you're describing a bit of a sweet spot for stocks. We've got excess liquidity. You've also got the recovery happening in the big economies of the world, and then a strong recovery in the emerging markets. But this can't go on forever. The excess liquidity won't be there forever. When's the tightening going to start?
As far as the U.S. economy is concerned, we think that the tightening of monetary policy will be later rather than earlier. As Mr. Bernanke has been saying, he will want to keep interest rates low for an extended period of time, because one of the key indicators for him to watch is employment. And as you know, employment growth in the U.S. actually is not happening as yet. So he will have to wait until that happens first before he looks to tighten. So that will be still quite a long way away.
Tell us quickly, are you concerned about asset bubbles in China?
In some luxury property sectors, yes, I think that the price is a bit too high. But overall, for the housing sector in China, I think that it still is very healthy, because there's still a lot of people in China who want to upgrade their homes. So we don't think that it is a nationwide kind of bubble.
Khiem Do there from Baring Asset Management. Thanks so much for joining us.